It's not that ANZ's result was particularly bad. Profit rose 12% after all. But that was mainly because the provision for bad debts was cut. ANZ's result today and Westpac's yesterday have both showed that the banking business in Australia is quite difficult at the moment. There's plenty of deposits coming in, but demand for loans is weak. And with what's going on in Europe at the moment, the bank managers are not forecasting that good times are around the corner, which is why the Reserve Bank cut rates on Tuesday, of course. Nevertheless, retail sales rose in September for the fourth month in a row, which is not exactly a vindication of the rate cut. And what's more, tonight's graph shows that retail sales are no longer a proxy for household consumption overall. They used to be, but now we're spending more on health, education, travel and online shopping from overseas, none of which is included in the official retail sales figures. As the chart shows, household consumption is now rising at 2.9% a year, but retail sales are growing at just 0.2%. Wall Street produced a strong rise last night after the Federal Reserve came out with a monetary policy statement after a two-day meeting that contained absolutely no surprises. The US economy is improving, but interest rates are going nowhere. Despite the rises on US and European markets, though, local share prices fell again, although not by much. The biggest falls were suffered by the two big steel makers, and the biggest rises were by the two big media companies. The Australian dollar fell another cent. It's been falling about a cent a day lately in response to the growing risk of big problems in Europe, but also because the Aussie currency got a bit ahead of commodity prices. As the chart shows, there's usually a strong relationship between the two, but during October, the dollar rose much more than the commodity index. So time for a bit of mean reversion. And that's finance.